Hello and welcome to Virtual Investor Conferences. My name is Bob Power, and on behalf of OTC Markets, we're very pleased you've joined us for our next presentation from JRNGF, a Canadian oil exploration and production company, ranked number 5 on the 2022 OTCQX Best 50 list and ranked number 1 on the 2023 OTCQX Best 50 list. Please note you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Alex Verge, President, CEO, and Director of JRNGF, which trades on the OTCQX Best Market under the symbol JRNGF and on the TSX under the symbol JOY. Welcome, Alex.
Thank you very much, everybody, and good day, everyone. On behalf of our management team, I would like to thank the OTCQX for providing this format and for creating this platform. I am sorry that we are unavailable to do this live, so we've done a pre-recorded recording right now, and we are available, and we look forward to having follow-up with anybody who this tweaks the interest of next week. Since our purchase of our banking syndicate in October of 2020, just over 2 years ago, almost 2.5 years ago, we've transformed JRNGF into a low decline, free cash flow generating company. And as Bob mentioned, that did put us on the OTCQX top 50 list 2 years in a row. We are a growth company, and our business is predicated on lower prices for assets, and volatile times like this do create huge opportunities for us. So I look forward to going through our slide deck with you, and again, I look for further follow-up. So today, JRNGF is undergoing a substantial change in our business, led by our acquire and develop growth model. We became unbridled in 2020 with the help of our largest shareholder and our second lien debt provider. We unwound our hedge book and we purchased our banking syndicate at a discount. And this was kind of a one-off because not only do we purchase our banking syndicate at a discount, but our second lien debt holder passed the vast majority of this discount onto the common shareholders of JRNGF. So that was kind of a one-off back in 2020. And this initiated the start of our buy and exploit business model with a focus on assets that have been undercapitalized for years. Both our own assets have been undercapitalized for years because we haven't had the capital to develop them, and the assets that we choose to acquire have also been undercapitalized. So if you take anything away from this presentation, it's that one comment on the bottom of this slide, and that's the overarching theme that we don't really care how we make money for shareholders. We just care that we make money for shareholders. We want the company to be better today than it was yesterday, and we just keep focused on being better and better for tomorrow. So on the 28th of July of last year, we announced a significant transformative acquisition. That acquisition closed in October of 2022. At the time we did the acquisition, our debt was about $30 million. That increased our overall debt to the end of the year to about $100 million. And because our debt had gone up to acquire those properties, we've been taking a very conservative approach to our business in 2023. We've been prioritizing our debt reduction over our production growth. Again, we have had a lot of volatility in our commodity prices this year. And again, fortunately, we control our own destiny. Through our capital program and through our low corporate decline, it allows us to prioritize our balance sheet reduction without significant deterioration in value of our business. Pro forma with this acquisition, we are an excellent free cash flow generator. We have very low corporate declines in the 12 to 14% range. We have good tax pool balances, relatively low share count, low leverage, and valuable strategic relationship with AIMCO, who is our largest shareholder and our second lien debt holder. Volatility creates this opportunity, And with our disciplined approach to acquiring and developing underappreciated assets, we have the ability to turn opportunity into incremental shareholder value. So in October of 2022, we did take on more leverage to do this acquisition. And the way we financed the acquisition was through a vendor take-back loan. So this loan has monthly principal payments, and we were able to convince the vendor that these monthly principal payments would be tied to commodity prices. So I'll talk a little bit more about how we creatively financed this acquisition, because I think that was another one-off for us. But I'll talk about that in a few slides. So in the first week of June this year, the second point to this slide, we entered into an agreement in our Gilby core area, and that's going to provide us access to proven Duvernay acreage on a contiguous 50-section block in and around our Gilby operated infrastructure. And we've tied up this block through various agreements for up to 7 years. So again, the second thing we're doing is adding inventory in repeatable plays. In addition, in 2023, over half of our capital is going to be spent on two significant power projects. That it's going to increase our power generation to the Alberta power grid from about 4 megawatts to over 35 megawatts by early 2024. That's the third point on this slide. And, as always, we are looking for ways to continue to expand our business through acquisitions. So what I'm here to say is that we are achieving material progress on basically all of our goals for the year. What's happened in commodity prices since the end of last year? It's been a little bit of a downward draft in commodity prices, but what I want to highlight is that based on where our reserve report evaluates assets, we've had a lowering of prices. Last year we achieved $95 WTI prices. This year, we're currently forecasting $75 WTI prices for the first half anyway. We don't know what the second half will hold, but at $75, obviously that's a lot lower than $95. But our reserve report already, assumed these kind of price reductions. And so I look at our reserve report and say, it's more or less pricing in about an $80 WTI world. So the point is that our longer term value and the value of our company that we have, announced with our reserves, it's impacted in the near term by the recent price drop, but the long term value of the company is intact. I think this slide is quite important. It's a busy slide, but it contains a tremendous amount of information, and it's all of our business plan, and it shows you how far we've come. It shows that our assets have not seen a lot of capital. You can see the capital on there, have not seen a lot of drilling activity over the last few years. What I will say is that our corporate debt peaked in April of 2020 at about $132 million. That debt level was under $30 million by mid-year 2022. So we dropped $100 million in debt while more or less maintaining our production per share over the whole period. So in 2020, our cash flow, absent the hedging, was like $6 million, and last year was over 15 times that. So with the acquisition, our debt increased to about $100 million at the end of last year. We're forecasting exiting 2023 with debt of about $68 million. So a material reduction in our debt year over year, debt to cash flow staying below 1 times by the end of this year. So we will talk about this acquisition here in the next few slides. The acquisition right now represents about 40% of our cash flow, and we think that the acquisition is extremely compelling in the way it was financed and very accretive to shareholders. So we'd like to repeat that again. In February of this year, we released our year-end reserves. There's a lot of takeaways from our year-end reserves. I'll talk a little bit more about that in the next slide, but on this particular slide, I want to draw your attention to the PDP, which is proved, developed, producing RLI reserve life index of about 8.3 years. I think this is top quartile, if not top decile among our peers, and it's a testament to the low decline nature of our asset base. So this is basically taking our reserve report data on the previous slide and just applying, net debt and number of shares to get a simple net asset value. So I know that some of this is due to the tailwind of commodity prices. So obviously, commodity price tailwinds, the torque to rising commodity prices is a really good thing. But another real driver of this was our ability to maintain our production through our exploration and development program, but continue to grow our value per share through highly accretive acquisitions. So Journey right now is actually trading below our PDP value, or the produce out value of our assets is trading at about a third of our 2P value. And the compounded annual growth in net asset value over the last 2 years is over 100%. There's a number of high growth companies out there that have grown their production per share by about 30% year over year. But where we're differing from that group is how we're doing it. So by doing it through these acquisitions, we're increasing our production per share, but we're doing it without increasing our corporate decline rate, which means that our assets are going to stay around for the longer term. Often when you just do it through drilling, you just wind up increasing your corporate decline rate and making it much faster. So why does doing this kind of thing make so much sense for shareholders? And this is a new sort of slide concept that we put into our deck. And anybody who's been around in the industry in the late 90s and the early 2000s appreciates what happened year over year to reserve report pricing and year over year to value growth. This slide basically starts around the end of 2014. And from late 2014 to late 2020, we were in what I would call a falling commodity price environment. So every year, the forecasted pricing for future years dropped, and you wound up subtracting the declining value of your base from your additions. So you get your additions for what you did during the year, and then your base would fall by a little bit, and you would have maybe a net positive, sometimes even a net negative. So every year the banks saw less value. They started cutting bank lines. They started consuming your free cash flow in order to reduce your bank line. So, when we started back in 2014, when we went public, our bank line was about $220 million, and our bank line was subsequently cut year over year to below 75, and then in 2020 to zero. So the reality of the situation is you're using all your free cash flow to pay a reduced bank line. Well, since 2021, starting in 2021, we started to go the other way. 2022 prices were better than 2021 prices. 2023 prices are better than 2022 prices. So, never before we had such clean balance sheets. Never before we had such high free cash flow. Never before have we had such low multiples. And low multiples for the industry means low multiples for the acquisition. And in this environment where every year commodity prices are a little bit better or the same as they were the year before, that favors a larger growth model and growing your base every year. And every year your base gets bigger, and every year your base gets more valuable. So a low multiple acquisition, like the one that we did when we bought at a low multiple of cash flow, and an acquisition that generates high free cash flow, can basically help pay for itself. So I'll talk a little bit about how our recent acquisition did that. So if we talk about the acquisition in general terms, closed on October 31st of last year, it makes Journey better in almost every conceivable way. Low decline assets, about the same decline or lower than Journey's. High netback, 71% liquid weighting. And it increased our production by 40%, but it more than doubled our free cash flow. It reduced our corporate liabilities relative to our cash flow. And my belief is that in this current environment, acquisitions are more effective than share buybacks. And because we use leverage to do the acquisition, the leverage accretion that we got was really attractive. And we basically used the asset to pay for itself. So how did we do this? Well, like the bank buyout in October of 2020, the funding of this acquisition is what I would call another one-off type of opportunity. And it defines the creativity that we have and the creativity we're willing to use. So essentially, we paid the headline price was 140 million for the acquisition, but it was effective May 1st. By the time we closed the acquisition at the end of October, it had cash flowed 30 million on its own, so we only wound up paying 110 million dollars for it. Our pro forma reserves, effective January 1st, show a PDP that is materially higher than this, almost double this. And on top of that, over half of the $110 million we paid on the acquisition was funded with the help of the vendor through a $14 million equity infusion. In other words, the vendor took back 3 million shares of Journey that were valued at $14.2 million, and through this vendor take-back loan. The vendor take-back loan is about $45 million, and we make principal payments on that loan as well as interest payments every month. But the principal payments on the loan were tied to the price of WTI. So if WTI was over $100 a barrel, they would get their payback in about 10 months. But as WTI has continued to drop, our monthly principal payments have continued to drop. If WTI goes below $70 US, we only pay $1 million a month in principal payments. So at $70 US oil for this acquisition, we'll pay $16 million over the year in interest and principal payments, but the asset itself will cash flow $42 million. So essentially, with this vendor take back and the share purchase, the vendor basically helped us pay for more than half of the acquisition. The next thing I'll talk about briefly is our power business and how we're expanding that. And, Journey has a lot of assets under water flood. We'll talk some more about that. But the reality is there's a lot of moving parts. There's a lot of water being cycled. We do use a lot of power within Journey. So a significant chunk of our operating cost is power. In fact, in 2022, where we experienced record power prices, about 25% of our overall operating cost was power. So in 2023, one key aspect of our capital budget features the expansion of our power business. We're expanding our power business to 35 megawatts from 4 megawatts currently. We have a 4 megawatt power project operating down in our Countess area, and we're doing 2 larger projects this year. We have a 15 megawatt preliminary approval to supply power to the grid in our Gilby area in central Alberta. We procured the generating equipment. We're in the final stages of approvals. We hope to begin construction on the building to house these generators this summer, and we plan on having this facility fully online sometime in early 2024, hopefully in the first quarter of 2024. So that's one of the projects. The second project was a project that we agreed to buy in November of last year, but we closed in April of this year. That's a 16.5 megawatt power plant in Mazeppa, Alberta, just south of Calgary. Last November, we began the process after we were selected as the winning bid for the facility. We began the process of restarting this facility in place, and this process is ongoing. Last month, we actually closed on the purchase of the land that the plant was sitting on. That was one of the larger hurdles to restarting it in place. We didn't own the land the plant was sitting on, and we had committed to moving the plant. Well, now we do own the land that it's sitting on. So we're gradually and slowly eliminating all of the barriers that would prevent us from just restarting this facility right where it is. To be clear, we bought this facility for what we think is about 1/6 of the replacement value. So although we had a much later start in Mazeppa than we did in Gilby, the fact that this facility used to run, it ran in about 2017, and it ran for less than 6 months. It was built brand new, and then the Orphan Well Association shut in the company that owned it for failing to meet their obligations, and this facility got shut in along with it, and it just sat there waiting for that to go through the process. So because this is a fully functioning facility, I think it bodes well for having this plant on in a similar timeline or even sooner than our Gilby facility. So by the end of Q1 next year, regulatory issues permitting, we want to have 35 megawatts of power on the grid. This will be more power on the grid than we're taking off the grid, and it will basically substantially offset our power power requirements, and it will make Journey much more sustainable. So moving on to just talk about our asset base pro forma, we've tied up over 1 billion barrels of oil in place within our pools in Journey. A large portion of this oil is already under secondary recovery. And over time, we're going to expand and optimize both our water floods and our enhanced recovery project down in Medicine Hat, Alberta, to continue to mitigate our corporate declines. Over the next year, we plan on focusing on a pool extension and polymer expansion in our Medicine Hat property to the south, a pool extension and a water flood expansion in our South Skiff pool, and a water flood expansion and some infill drilling in our East Mats 1 pool. Those are a few of the projects that we're working on over the next year. In addition, we're drilling 3 wells in our Cherry Hill pool, which is also already under water flood. So, as a company, Journey is full of attractive E&D projects. The company has been capital starved for years. It's funny how companies like ours are all trading, below our produce out value today, but that's at a time with higher commodity prices when our inventory is more valuable than ever before. So as commodity prices continue to expand, our inventory grows because projects that weren't economic before become economic. Our projects become more valuable, and our corporate upside torque to rising commodity prices increases because things like debt and end-of-life costs all stay the same, and the value proposition goes up. So we trade below our PDP, but we are doing this at a time when the chance of achieving our 2P is better than ever. So the ability to add value to these legacy pools is reflected in this opportunity inventory. We have over 15 years ahead of us at current rates, or if we prefer to look at it this way, about 600 million in capital projects. Only 40% of these projects are booked in our reserve report. So at the end of the year, reserve report prices that we were using, our unrisked rates of return on these opportunities are close to 100%. And for every dollar of future capital that we spend in our reserve report, we generate $1.10 in net asset value at 10% discount rate. So because of that, if you expand this across our entire inventory, we're generating, $700 to $800 million in future development potential, which is, more than $12 to $13 a share for Journey. So when we established the company about 10 years ago, we wanted to build our company around medium depth drilling and established pools where lands are held by production. They never expire. We knew that these pools were more marginal and they had higher operating costs, but they also had more predictable production profiles and significantly more upside torque to rising commodity prices. Pro forma, like I said before, we have over 1 billion barrels of oil in place. What's really important is that after we're all said and done with all of our inventory and all of our ideas and all of our projects developed and undeveloped, we're still going to leave more than 85% of that oil behind. So, if you want to talk about commodity prices going up over time and the ability to do more, there is a huge resource there for us to access as things get better economically and prices increase. So, in my view, bigger pools get bigger with time and technology. As the marginal cost to replace 1 barrel of oil rises, and it is rising, believe me, the barrels that you have under management become more and more valuable. So we do have a couple of slides in our corporate presentation on the value of our projects versus pricing at certain fixed AECO gas prices. There's a lot of projects in our portfolio that are generating rates of return greater than 100%. So further to this, we have a diverse group of opportunities. The clear disadvantage of this is maybe a lack of repeatability. We don't have one repeatable play. Now that we're building the Duvernay inventory, we're starting to accumulate that. But we don't have a play where all of our eggs are in one basket. So the clear advantage to this is that we don't drill 10 wells only to find out the first 2 didn't work. We mix up our projects. We basically mix up shorter payout projects with longer payout projects. in order to better match our existing declines and provide reserve growth. Like I say, most of our projects pay out in a year, but the beauty of our inventory is it's all in existing pools. So it's all held by production, so it never expires, and so we can control the timing and the pace of development. That's why we can drop everything and shift our focus when we're given the opportunity to do a transformative acquisition. So in 2023, I think it's a classic example of that. Prices are low for commodities, cash flows are down. Prices grew so quickly last year that most companies thought $100 oil was here to stay, and they didn't follow through with their plans to sell assets and reshape their business. Now the commodity prices are down, they're busy trying to take advantage of it, of what they didn't do last year, and there's a lot of assets for sale in the marketplace. So a significant number of assets for sale combined with relatively low prices is a unique opportunity for companies like ours who have a business model that is focused on acquiring assets at competitive prices. So it's generally the kind of environment where we will favor slowing down our drilling to pursue further acquisitions. So, our disaster scenario for the year basically is pay off a big chunk of our debt, put on these 2 power projects, which pro forma will be worth $80 to $100 million. So that'll create somewhere in the neighborhood of 125 to 175 a share in net asset value. That's kind of the worst thing because, none of us really, as I finish up, I want to say that none of us really know what the future holds. But if this 2-year trend in rising commodity prices continues into the future, and we do enter what I think may be a new commodity super cycle, the things that we haven't done during the lean times are going to prove to be highly economic in this higher pricing environment. And in my view, it's kind of rates for show and, reserves for dough. And the barrels under management really matter. So in conclusion, again, I'd like to thank the OTCQX for providing this forum for Journey to introduce ourselves to you. I would like to thank all of you for tuning in to hear our presentation today. And if this high-level overview tweaks any of your interest in any way, I'd like to invite you to reach out via email. The email that we can use is info@journeyenergy.ca. And I would like to encourage any of you to reach out and allow us the opportunity to provide some more detail on our business plan and growth strategy for the future. Thanks, and enjoy the remaining